Hello, everyone. This is BFW 2401, week 10, and this is part 2. Now, in part 2, we'll talk about the OBS, non-market related, which means not the derivatives, only the non-market related, the guarantees, the services, and the other issue, and the commitment. Now, to move from here, let me just. So when we talk about this part, actually we want first to define what is the OBS balance sheet businesses, and OBS related to the transaction, which is at the time of their origination, cannot be classified as either an asset or liability on a bank balance sheet, also called non-market related off balance sheet. Now, this is a little bit different from the derivatives, as I told you. And examples is services, contingent claims, and the contingent claim can be direct credit substitute, or performance and trade-related contingencies and commitment. And we will explain in the following slides those items one by one. Let me start first by the services. Now, the services, banks do that. They deliver a lot of services. And for those services, they receive agency fees, commissions, brokerage fees, other service fees. And this is actually a considerable amount of money that is because they provide those services. Now, examples of those services can be cash handling services. For example, they move the cash of the banks through the ATM machines, from the head offices to the branches. They can do all those things. They can also do transaction services. They also can do credit cards, where they provide the credit card as a service, but then without being a loan. They do financial advice, and they act as a broker. Now, all of this can create some type of risk called the operational risk, which means if you don't deliver the service as you are supposed to, or if there is any lack of due diligence in providing those services, the bank will be liable, and when they will be creating a liability, and that liability can be on balance sheet. But when they make the contract, all of those nothing is written in nothing is recorded in the balance sheet or in the books, but recorded, as off balance sheet. Now, let me give you an example, and this is actually happening in Malaysia a lot, in other places, but I know it happens in Malaysia. Now, one of those things is actually almost all banks in Malaysia here, they provide what we call their asset management. So you will find, for example, Maybank has a fund. Now this fund, mutual fund, for example, will be run by CIMB. Public bank can run a fund because they have, for example, good managers or whatever. They can run a fund for another bank, say Maybank. And in that, they don't have claim over the assets, but they have maybe the expertise and the managers who can run that fund. And if there is a problem, then the public bank, for example, as the one who is running this fund, will be liable. So the asset manager or a broker, the assets managed or brokered as part of this offered services, often securities, usually belong to an individual client or individual bank. Although the bank, for example, public bank in this case, provides management, depository, or other services to the client, the bank itself has no direct claim over the assets. So it does not actually record them on its balance sheet. They are just off balance sheet. However, it usually has some basic fiduciary duties with respect to the client, which means it can create a possible liability, future liability. if the client, of course, can prove that there is a lack of due diligence when they run those assets or provide those services. A financial institution may report off-balance sheet items in their accounting statements, statement formally, and may also refer to asset under management. A figure that may include on and off balance sheet items. But I told you, if they are running a fund, it would be off balance sheet, but it has to be, of course, mentioned the financial reports under the part of the notes. Now, let's move to the second part, and maybe this is the one of the most things banks do is the contingent claims. And these contingent claims are two. One of them called direct credit substitute, and the other one called performance-related substitutes and trade-related services. Now let's talk about the credit direct credit substitutes. Now banks are very smart. The way they do, they use this trust economy, and they let people lend and borrow in the market and let the funds move within the market without giving loans and without receiving deposits. And in this case, actually, they receive only the fees. So if A, which is the borrower, want to borrow from B, which is the lender, lender maybe have a credit risk concerns when he gives that loan to A, but he's willing to give the loan because he's going to receive some return. Borrower A is also willing to pay that return, but lender actually needs some type of guarantee. So they go to the bank. So the bank will guarantee that A will pay to B on maturity. And if that happens, they receive a fees. And this is how they actually credit substitute. So now I want you to understand something about credit substitutes here. Would the bank provide the guarantee and become the guarantor in this case, the payment will happen end of the day. When the contract matures, the payment has to be executed, either by the borrower, which is the normal thing, or by the bank, which is the guarantor. Now, the problem is if borrower default and doesn't pay in maturity, bank becomes liable, and now it becomes a liability. And this off-balance sheet business will become off-balance sheet business as a liability. This is only in this case if a default. And usually we don't say that it's exceptional thing that A will default. But people who see the financial statements and the reports have the right to see how much money, how much the bank is guaranteeing for the direct credit substitutes. Now, to talk about the guarantees, we can talk about the guarantees, the standby letter of credit, the bill endorsements, and the written options. Just like talk about that briefly. Now, the standby letter of credit, when we say standby letter of credit, maybe your mind will go to a letter of credit, which is actually the international trade. No, this is only a guarantee. Deal with it as a guarantee. For example, if somebody wants to issue bonds, but if some corporation want to issue bonds, but the lenders, which is the people who are going to subscribe in that issue of bonds, or the investor will buy the bonds, are actually not really guaranteeing, or they have some concern about the credit risk of the issuer. So the issuer will take the bank will issue a standby letter of credit saying that if the issuer didn't pay, the bank will pay. Now that issue of bonds will just be sold very fast because there is a guarantor. And this is what we call standby letter of credit. So the payments will happen on the day. And hopefully it will happen by the corporation who issued those bonds. If they don't pay, then the bank will pay. Now, meanwhile, this is actually on off-balance sheet. When you issue this guaranteed standby letter of credit, it's off-balance sheet. But later on, when it matures and the payment comes, if the corporation, which is the issuer, pay, there is no issue. But if they don't pay on default, then this on off balance sheet amount of this guarantee will move and become liability on the on balance sheet. So this is what you call the direct credit substitute, just an example. Another one is don't worry about all those graphs, whatever. It's an easy issue. And this is a very common type of guarantee bank, credit substitute bank do. So inside the market, people want to borrow, and people, as I told you, want to lend. So actually, when we talk about the bill endorsement, so the customer, for example, which we call it now, the borrower, which we call it now the drawer will issue this note. Now, which will issue this bill. Now, this bill, assuming it's for 100,000, and they will issue it to somebody else who is the investor. And in this context, we call it the discounter. Now, the discounter will take it maybe now and get 95,000. Hopefully, he will receive 100,000. He will receive the face value end of the contract. So if the contract is in 28th of October 2020, and then in 28th of December 2021, the drawer expect to receive 100,000 for the 95,000 he paid for the drawer. Now, when this happened, it should be happening between the borrower and the discounter. But actually, and this bill is issued by the borrower, by the drawer. What happened is now the drawer will go to the bank with this bill and let it endorse it, which means stamp it with the guarantee. And they will give it to the discounter. This is on the 28th of October 2020. Now, what would happen now in 28th of October 2021? The bank actually, the borrower, the normal practice actually, the discounter will provide the bill to the bank. The bank will take from the borrower and pay to the discounter, which means the discounter actually will go to the bank. The bank will pay him the 100,000, and of course they will receive the 100,000 from the borrower. This is the whole thing. Now we are talking about 100,000. It could be 100 million. Let's go to another one, which called documentary letter of credit. Now this one, now we are talking about performance related. Now, as you see, when we talk about credit substitute, the amount will be done, will be executed, and maturity has to be paid. There must be a settlement. In the performance part, the settlement is not there. It's only if the performer fail to perform as the contract. For example, if Sunway University, I think most of you know, they are running this, what we call Monash residence, Sunway Monash residence, SMRs. They have these huge buildings. If they want to build a new one or two of them, then in this case, they will make some type of bidding and the contractors will come. When they receive the bid, and this is all governments, you talk about roads, you talk about buildings, you talk about construction, you talk about anything, they usually will ask the contractors to provide a guarantee. And this guarantee usually 5% when you put the bid, when you submit your bid, which means if they give you the contract, they need to guarantee that you are going to do it. And then when you take the contract, they want to guarantee that you are actually going to perform according to the contract. And when you submit the contract, the building, they want to know that the job has done as it is supposed to, and they will have what we call a maintenance period, and they will take another guarantee to see whether the building, nothing happened to the building after 1 year or 2 years. Okay, so all of those guarantees actually, if what we call your client as a bank who is now the person who has who whom the bank is guaranteeing to do the business as the contract, if he doesn't default and perform well, nothing will happen from the third party. Now, remember, you have Sunway, you have contractor, and maybe you have public bank. Public bank is the one who issue to the contractor the guarantee. The guarantee will be submitted to Sunway. Sunway will give you the money to start the work, and then we'll continue with this, the bidding, the performance during the contract, and the maintenance after the contract ends. If everything is fine, Sunway will not come to the bank, and therefore this guarantee will stay on balance sheet, off balance sheet. It will not move to the balance sheet item because nothing happened. But if the performer did not perform well, then in this case, the bank, this liability, this off balance sheet item, which is a liability, will move to the on balance sheet, and you have to pay the third party, and it will become a liability. This is how guarantees work. So this is actually the guarantees. We have something else called trade related. Trade related is those LCs, which is actually letter of credits, which actually done through the international banks. So, for example, if you want to import from China, from Germany, from the US, from any country, you have to have some type of letter of credit. So, because you don't know, you are an importer, for example, in Malaysia, and you don't know the exporter in Germany. For example, you are importing 100 electrical cars, those top cars from Mercedes, and you want to import it to Malaysia. Now, this could be 5 million or maybe 10 million ringgit money. So the importer, Mercedes maybe will take some time to manufacture those cars according to your specifications. But before they start, they will ask you to open an LC, a letter of credit. So you will go to your bank, assuming you are Maybank customer. You will ask Maybank customer to open. You will ask your Maybank to open an LC. This LC will go to some type of German bank. The German bank is actually the bank of the exporter. So they will inform the exporter that the LC is open. Now you start manufacturing. They will start manufacture. They will send the cargo, and they will collect the money from the German bank. And the German bank will collect it from the Malaysian bank. See how the situation, and there is a process, and and it's very important if you are going to do, import and export. Forget this e-business. E-business is just 3 small items, but we are talking about 10,000 ton of wheat or 30,000 ton of rice coming to Indonesia or to any other countries, so or exported from Indonesia or some other countries. Then in this case, you are talking about LCs, and the LCs is actually explained here in the 10 steps. So you have Malaysian bank, you have foreign banks, you have Malaysian importer and foreign exporter. So if you follow those steps, you will know that the Malaysian importer will ask, for example, they will agree for number 1 here to talk to the foreign exporter. Foreign exporter will ask to open LC. The LC will be opened by the Malaysian bank. They will form the foreign bank and the foreign exporter. Then this will start manufacturing. And number 4, he will send the goods. The goods will come by the sea, and then there is documents called bill of lading, backing, whatever. They will send it to the foreign bank. Now the foreign bank will send this to the Malaysian bank. Malaysian bank will send the money and collect the money from the Malaysian importer when the goods comes. And why the Malaysian importer has to pay? The Malaysian importer has to pay because he cannot receive the documents. And the documents like the bill of lading, if you go to the port and you want to take your cargo, they will not allow you unless you have all these documents, bill of lading, bill of backing, and stamp from the bank that you already settled and everything. So this is the process. Fine, this is what we call LC. But how is this related to on-balance sheet and off-balance sheet? I will tell you, what if the Malaysian, after the exporter, the foreign export, after you open the LC, you are committed now to pay. It's a guarantee. Now, when the foreign exporter finish actually the manufacturing the goods, he will ship it and he will take the bill of lading from the ship and go to the foreign bank and receive it, assuming that the Malaysian bank will pay. Now, the Malaysian bank, of course, will pay, but if the Malaysian importer default and they didn't receive the documents and the goods stay in the port, then in this case, it will become a liability and it moves from the on-balance sheet to the off-balance sheet. Now here we talk about two items. First, please understand how this LC works, which is not a big deal, but the most important for us is how this becomes an off-balance sheet as a performance. So we have performance when I talked about Sunway and the contractors, and here also a performance, which is a trade related. So we have performance and trade related. This is a trade related items. Now let me come to the guarantees, normal guarantees. Now the government guarantees, as I told you, this is if somebody wants. This is like the example I gave you about Sunway. So here is a bank. John may be the one who is contracting to build the house. For the bank customer will pay a fee. So this is a contractor. This is the person who wants to buy the house, to build the house. Last time we talked, in this example, we talked about Sunway. Now just assume another example. So he will pay a fee, receive a guarantee, give the guarantee to John. John will give him the money, he will start the work. But if the work is not performed as agreed, now the John can claim from the bank. This is how guarantees work. Now, this is only for businesses, but you can use guarantees when you get people out of prison. You can get guarantees when you bid in something. You can get guarantees in so many things. Now, finally, we come to something called the commitments, and the commitments, I think it's off balance sheet now, because you are committed, like the sale and repurchase agreement. What is the nature of the sale of repurchase agreement? This is actually when you sell your securities, you promise them, for example, to the central bank, you want to solve your liquidity problem now. You sell them, but you promise to buy them after 1 month. Now, within this 1 month, if you are reporting within this month, this should be shown as commitment and off balance sheet, because there is a promise that will be executed. Now we are talking about 1 month. It could be 6 months. This is one of them. The other thing is the outright forwards. Now bank promise to sell, as I told you, corporation want to issue up bonds, but they are not sure that people will buy their bonds based on their credit quality, or maybe reputation, or maybe whatever, or credit risk in the market in general. So they go and they ask the bank to provide them some type of guarantee in the future. So they promise them to give them the if this customer is planning to issue the bonds next year, they guarantee them to buy them or sell them after 1 year. Then in this case, it becomes off balance sheet. The second thing is bank promises to buy or sell amounts of foreign currency. This happened to bonds. This is happened to foreign currencies. Underwriting facilities is a big one, and we already know it. And I think they do it a lot in this country, and and so many countries. And actually banks collect a lot of fees. So when you go for the IPOs, sometimes we go to the secondary market. Sometimes we just issue the IPO and go to the secondary market. But sometimes you will ask what we call underwriter. I think Hong Leong do it here, a public bank do it, CIMB is doing it. So these people will buy the whole, if you are a private, for example, in Malaysia, you have to be a private company for 5 years. If you want to shift to be a public company, then in this case, you will do this IPO, and IPO has to, if you have an underwriter, for example, arranging with bank, so you will give it to them and they will buy it, for example, against some type of discount and fees. Now, why it is off balance sheet now? Because you just promise if a company is going to go public next year, which means they want to file with the Security Commission next year, then in this case, they want a bank from now to promise them that they will buy their stocks or the IPOs, the initial public offering now, and after 1 year, they just hand the the issue to the bank, to the underwriter, which is usually a bank, and receive the money. Now, so what? So in this case, between this year and the next year, when they start to issue it, this is becoming a promise, and this promise is becoming a commitment because you are committed to buy it, and it has to show in the balance sheet. When you buy it, it will be in the balance sheet. And finally, the loan commitments. We will talk about loan commitments a little, in the future. I think in the tutorial also, and maybe in the workshop. But the bank promises to lend an agreed amount. They promise governments. They promise big customers, whatever. They collect what we call upfront fee when they sign. And then it's just a promise to a customer or a big customer or small customer to buy those, to give them the loans in the future. So what in terms of why we are concerned in this stage? Because between now until this commitment crystallized, you are actually off balance sheet, and it will be a balance sheet, an asset like a balance sheet loan when you issue it. But customers and regulators and investors has to know that you have these commitments in the future. I am done for part 2, and I will see you actually in part 3. Thank you very much, and see you in part 3. Bye-bye.